Yeah, so Jamie Macgregor, I'm Senior Vice President for Celent, the insurance practice. Just for information, if you don't know who Celent are, it's a research analyst firm, as Connie just mentioned, and we're owned by Oliver Wyman. What I want to do today is really sort of take you through a view of what digital could be for the industry, and then give us some views, really, which two points might be provocative, might be the truth, of why I think digital is quite an important topic today, and why has it suddenly come up now. The genesis for the title of this session came from me just reflecting on, I guess, my period in insurance and insurance technology, and thinking back to many meetings that I've been in where I've heard so many times people say, all we want is an Amazon-style experience. Yet, if you look at Amazon, Amazon was founded in 1994, so this is a 22-year-old business. So why is the insurance industry still talking about it today? Sort of why 22 years later are we still talking about it? So that's what I want to cover over the next 20 minutes or so. So to start then, really, there we've gone too far, is I'm going to show you some collection of some of our research, both on the insurer side of things, but also on the sponsorship, on the consumer side of things. This was one question that we asked at the end of last year, really about sort of two insurers, just asking the question, agree or disagree with this statement. And, digital is a major force of disruption for the industry. And as you can see from here, it's sort of like a no-brainer answer, really, isn't it? So 92% say yes, it's a major force for disruption. I wouldn't want to be in that 8% in a way. They may be right, who knows? But in some respects, it's sort of, when I reflect on it, it's almost like the sex, politics, and religion conversation at work, things you shouldn't have. That's now digital is added to that 8% on that list. But when looking over the last year, if you look at the headlines of certainly a level of frustration seems to have been building in the industry, or at least opportunity. And sort of May last year, when Mario Greco was at Celent Generali, he made a statement to investors which basically is sort of saying that insurance company will disappear unless they embrace technological change. Towards the end of last year, Aviva made a similar sort of comment, which was basically, I think the insurance industry is still in the Stone Age, whilst everybody else is circling around Mars, looking at comparisons between the insurance industry and wider industries overall. Pretty sort of damning statements from very senior people across the industry. I thought it was also interesting, over that time frame in the US, Allstate were looking at all the data, all the mileage data that we were building up on telematics for motor insurance, looking at it and saying, well, actually, there's some value in this. So should I be using this data as another service? Should I effectively be thinking about other ways I can use it rather than just the pure insurance piece? Now, obviously, there are huge ethical implications, privacy implications associated with that. But again, it sort of highlights the sort of way that the industry is thinking, both from a threat point of view, we need to change, but also from an opportunity point of view around digital. So why now in particular? Now, I guess the first point really I want to make is that consumers are demanding it more than ever before. And this is sort of an obvious point. So this was taken from some consumer surveys that we did at the end of last year. This is 5 countries across Europe. And generally, if you average it out and you look at the section this is across the whole of financial services, but you look at the insurance piece, over 50% are saying that they expect a decent digital experience overall. Contextually, if you take it in the financial services spectrum, you still see it's a long way behind banking, but it's over the 50% mark, not necessarily for all countries and for all products. If you take that as just read and just assume you believe that, then that's potentially a dangerous thing to do, because the market is not just a homogeneous mass of people. It's made up of different segments who want different things at different times. And another question we asked within that survey was really trying to understand, at what point do you want to engage digitally, and at what point do you think you need to reach out for support and for help? And we split that into 2 types of transactions. Simple transactions, things like a change of address, a lookup information, that type of thing, and complex transactions, quite often associated with either a purchase or a sort of major incident or what have you. And you can see that basically when it looks at simple transactions, and I've just mapped it again, age range, it's sort of in the middle depending on where you are around digital, but generally it's weighted towards more the self-service style approach. You want a digital engagement first for those simple transactions. When you get to complex transactions, the gap widens. And it's also interesting to actually see how age actually sort of affects that. And if you map it over wealth, you get a similar picture, actually, sort of similar shaped curve. So the wealthier you are, sort of the sort of your behaviors change. In fact, the wealthier you are, the more you want to self-service, actually. But you can see that it depends on the transaction, it depends on the age, and it depends on the position you're at, it depends on how you want to engage, and not necessarily always in the same way at the same time. The other thing which I think is interesting about this is the millennial piece. So we hear a lot about millennials and digital self-service. Yes, they do want a digital experience, and it's definitely a hygiene factor. But when it comes around to our products and the complexity of some of our products, these are people who haven't yet sort of experienced the industry and therefore feel that they need an educational piece and will seek out advice. It doesn't necessarily mean to say it has to be face-to-face. It's just a digital way of delivering it. And then if you look at it and sort of say, well, actually, how do you then engage around specific types of tools? Again, you can see certain patterns and behaviors. So designing a simple digital experience for all clients at all times off the same tool set is probably a big mistake. So it's not an or, it's definitely an and it's not a single solution, it's a multitude of solutions. I think if you look at it here, again, you can see that basically I've broken it down into what I've called 3 zones. So one of which is the familiarizing zone, whereas basically it's more likely to seek for some sort of advice-based channel because you're less confident. Moving into more the confident area, which is the career-building area, the professionals, wealthier, probably the most likely to want to self-serve and engage digitally. And then when you get to the older generation, there's still a preference for human touch where possible. But even within there, when you look at it, you see that there's a higher preference for things like engagement through a portal as opposed to things like a smartphone. So it's not, you can't blanket, you can't do this in a blanket way. The second point, really, of why digital and why now is that the products no longer fit the way that we live our lives. So this is just really an individual personal life story, really. So my parents' generation very much still fit in that mold. They assume that basically everybody, surely, they leave education, they get a job, they work for that same employer for the rest of their life, and then they retire. That's certainly not the way that the market is heading now. My generation and the generation after me will, in fact, take on even more jobs and have more breaks and periods, and will have a different life. If you think about the sort of many of the, certainly the life and wealth products, are they geared up to be able to manage this journey? Most of them aren't. Most of them are fixed-term contracts and still pretty much sold in a pretty antiquated way. They're not fit for purpose. In 2013, the Department of Works and Pensions in the UK just issued a figure that said, sort of UK adults on average have 11 different pension pots by the time they retire. That number's just going up, right? So if you think you've got a client and you've got them for 20 years, chances are you're not necessarily going to have a willing client for 20 years. The other thing as well is, and this is just really a very small part of the market today, but the way that we actually sort of accumulate assets and use them is changing overall. So I don't know if a few of you have seen what was in TechCrunch a couple of weeks ago, which was an article on the Chinese economy, and it said basically in there that the Center of National Information within China estimated that by 2020, the sharing economy would be 10% of China's GDP. A huge number, right? Not all of that is going to be insurance, but it's clear that certainly in some areas around the world and for some demographics, the way that we're going to think about our assets and our products and the way we want to insure them is potentially going to change. And you're already seeing some early examples. This is by no means necessarily going to be the bulk of the market. These are still going to be niches, but there's going to be sort of new opportunities that didn't exist before that require a different mode of operation, a different way of working, and a different business model to support it. So just for information, one time actually is quite an old proposition now in Tokyo Marine. That was one time for drivers, so it's targeting young drivers in the period when they didn't own a car. So try and basically just switch on and switch off cover via the mobile, which was just SMS texting more or less at that particular stage. Cover launched in the UK this year, 400K of funding, and SafeShare is a very early stage startup. That's just basically targeting the sharing economy and the assets. What's interesting about that one is that as a technology set as well, they started out on the blockchain. So they basically built their model around the blockchain. The other point, really, the third point to make is technology is just simpler than it ever was before. So when Amazon started in 1994, if you think about the systems that you were running as an insurer at that particular stage, they weren't particularly very open. They were pretty closed. Now, many of you may still feel that, but the reality is that over this period, technology has matured to a point in which technology integration is no longer the headache and challenge that it once was. It's definitely simpler. And it opens up sort of all sorts of possibilities for different types of business models, different types of propositions, engagements. So the growth of robo-advisor, loved the stuff with Trove earlier today and Shawgram. That definitely around the sort of bot-type way. If you think about it and then think about the need for human touch on the slide that I showed you earlier, those are ways of delivering digital solutions which give you access to advice and gives it very personal experience. If you think about telematics in the car, been around for a very long time, But propositions are popping up all over the place now around using the Internet of Things within them. So connected home is certainly popular in the US. Italy's a little bit of a hotbed as far as activity is concerned. You're starting to see other opportunities come out in other countries around the world. And health and lifestyle and well-being is certainly well and truly overtaking connected health as far as activity is going there. And drones as well. Drones last year was quite an interesting year for drones. There's about 7 or 8, maybe probably more than that, insurers that have got their licenses to pilot drones. And it's interesting from a multitude of different angles, both from a claims assessment point of view and from a damage inspection perspective. But also, if you think about it, when Amazon gets its wish and can actually deliver these packages, there's a huge insurance risk associated with it. So pretty exciting times. Now, when talking about digital, one of the problems that we have with digital is that it's sort of everything, really. So it's very difficult to define what it is. And when we started looking at digital back in 2012, we sort of struggled with we wanted a nice, neat definition because we're an analyst firm. The reality is that we sort of gave up on that pretty quickly. And he's in the audience, actually, Craig Beattie, sort of came up with this view, said, well, let's forget about the definition. Let's just talk about a continuum, because everything can be digital. And so we go from no digital to digitizing paper records, to using it as a sales aid, and then to ultimately building it into the proposition around data and underwriting. And then ultimately, could you ever get to this point of extreme digital, where in fact all an insurance company is an algorithm? Hold that thought. But its potential is, you can see theoretically there's a potential world where that could exist, not necessarily in the near term. The point at which it starts to get interesting is when you basically get to advanced digital at this particular stage. And I've split it between digital enablement up until that point, which is just enabling the business model. As soon as you get past the advanced digital, you're actually starting to change the proposition, the way that you think about your business model. And that's the point at which it starts to get interesting, in our view. And learning from some of the early advances in some of these solutions around advanced digital. So if you take telematics for motor, as I said earlier, it's been around for quite a long time now. But if you look at the learnings and the journey that's gone through, it's sort of gone through at least 3 stages, and there's a 4th one potentially that needs to be added to that one now. So when it first came in, it was just a silent witness. We'll give you a discount on your premium if you allow us to have your data. Then it moved into metering, usage-based, which was okay, it was interesting, but do consumers really want the hassle of having a variable premium each month? Maybe, maybe not. And then it moved into sort of behavior-based. So how can you use this data to change the underwriting outcome? How can you change the risk profile and put it into advice? And then stage 3 is when you start layering in context and start building in different pieces. Andrew Brem, who's the Chief Digital Officer at Aviva, is quite vocal in what he says about this, and I think it's fine for me to say it because he said it many times. What they've learned from basically telematics insurance and the potential transfer of that to other products is potentially a great opportunity. So it starts basically becoming quite a valuable source of data. But if you think about that journey and through the IoT and where it could all go next, it's a sort of potentially interesting on the overall business models. If I boil it down to 4 points, really, and you look at sort of evidence of what's happening around digital, the first one is really sort of, it feels like an undeniable trend that's moving towards from a periodic engagement where you may have had 1 or 2 times a year where you'd engage with the insurer to something more continuous. So an engagement based around the data and engagement based around the service. Second thing really is it's moving the proposition from being an indemnity post-claim event and a claims management process to becoming more of an avoidance piece. So it's about how can you, better than your competitors, change the underwriting risk of that individual and potentially change the moral hazard associated with that individual, which is often the hardest one to change that proposition. The third thing really is around the capabilities that it comes with it. I love the fact when you speak to some of these new sort of MGA-style models which are working in the telematics space or in the connected home space, and you look at sort of who they're hiring. I think it was interesting to see that Lemonade hired, or at least put onto their books, a chief behavioral scientist. A telematics insurer that we work with hires psychology graduates, not only to connect with the 17 to 25-year-old target group they're engaging with, but they hire psychology graduates for outbound claims event. It's not a call center event. It's not a service event, it's a counseling event, it's a psychology event. What they want to do is change the behavior, so they've invested in psychology skills. So it changes with, sort of the capabilities in the model are starting to change. We're not just purely focusing on throughput and process and operations. And the final thing really is the recognition that the ecosystem transforms and expands. So the insurance industry is not going to deliver all this stuff by itself. It's going to partner. It could try. Maybe there's a few very large players who could do it. But for the vast majority of the industry, which is still massive, partnerships are certainly increasing part of the model. So where's the burning platform? All that stuff is great, but where's the burning platform? Why has it taken 22 years for digital to be such a height of interest? For me, personally, I think there's two things. The first one is investment outlook. Insurers can no longer make money out of money when interest rates are either near zero or negative. They have to make money out of the core operating of the business, which means re-looking at the way that you're doing underwriting, the way you're engaging with the client, and making sure that you retain it. The second thing is revenue outlook. And this is potentially a depressing view. This was pulled together by one of our analysts, Donald Light. When I say it's a depressing view, it could be reality, it's a perspective. Certainly, the world is full of new risks, and the insurance industry will always have things to do. It's the question of, when the incumbent businesses, what will happen if the IoT comes in, and these models can be used to change risk outcomes associated with it. So, and the genesis for this, or at least some evidence for this, you could see over the last year. So there's a great piece of journalism in the Wall Street Journal last year, around about April, that went through all these sort of forward-looking statements of the insurers and spotted that new risks had come in around driverless cars. So it was both around distribution of insurance products, but it was also around the actual sort of underwriting risk. Allstate added themselves to this list this year as part of their forward-looking statement. So actually highlighting that driverless cars could be a major threat to the insurance industry. Why is it, potentially? Because a huge amount of volume in auto insurance premiums is pushed through insurers today. So if that starts basically being affected by either changing in patterns of way that motor insurance is distributed, either through the car manufacturers as opposed to the individual, or alternatively changing the risk profile, it has a potential issue on the future outlook. If you think about the IoT and what it can do around risk-changing behaviors and all that aspect, it's positive for society. It's great. If as insurers implement these things and put these things into services, it's really very good. But if you think about it from the industry perspective, well, what does it mean? But potentially it means reduced number of claims. Sort of good news from a society point of view. If you assume perfect competition takes place, what that implies potentially is lower premiums, ultimately, because perfect competition will take place, the abnormal margins that you could make would no longer be able to make, and the market will equalize around that. If you then assume that some of these things might be smaller proportions, maybe there's less margin on each product, which means you have to sell more to be able to achieve the same level of returns. What does that mean? Well, it means less capital to reserve, potentially. As you're not taking as much money in, you can't reserve as much against the risk. And it also means less premium to invest. So once the investment markets return, how are you going to make sort of money? So what does that mean, really? It means maybe you need less capital to start up an insurer than you ever used to if you're focusing on one of these niche areas. So that lowers the barriers of entry. Second thing, it means sort of lower shareholder returns, potentially, unless you can actually build the volume and really be the brand that dominates the marketplace. And the final thing really is sort of heightened need for efficiency, because as you move into this world of continuous engagement, the old periodic set premiums for the year are sort of unpredictable. You have to have more of a variable cost base, and you have to have a position sort of that you can adjust to this changing world. So the big implications are really you have to reinvent yourselves at a firm level and potentially at an industry level. Some of this thinking was put together way back in 2012 by Donald Light. He's recently updated this paper. There's an update due out shortly. And he's also written another one, which was a provocative title, I guess, which is, Can the P&C Industry Survive on a Fixed Cost Basis in the Future? So what does this mean? So if you take the essence of a digital business model, this is our view of really what a digital business model is. It's about delivering that engaging customer experience, that consistent output, but as number one. And then the other two important points for us, really, is what is it that insurance company really has to do well on top of that customer engagement piece, is really automation, and it's analytics and digital insight. And those feel like the key core capabilities that insurance companies need to really focus on, and less maybe on process and operations and all those aspects. So And what do we think about is sort of how we can see sort of some of these things sort of bearing out in the industry? Well, you can see it through high evaluations of some of these startups. So the first one that really sort of woke up people was Climate Corporation, which was sold in 2013 to Monsanto, a startup that started in 2008. It depends on what you read. 1.1 billion is the highest number I've seen on that one. If you take sort of another sort of darling, I guess, of the fintech space, Oscar in the US around healthcare, with the latest round of investment a few months ago from Fidelity, puts a valuation about 2.7 billion, but still a fairly small business to expand in more states. And if you look at the sort of the big one on the block, Zhong'an, which is the Alibaba Ping-An joint venture in China, depending on who you read, it has sort of valuations of 8 to 10 billion. And these are all highly digital models, built on analytics, built on excellent customer engagement, and potentially a different model altogether. So you know, there is some evidence to suggest it. When we asked insurers where you were in this journey, if you take your own digital transformation journey, what are you investing in? And go back to that digital continuum with digital enablement, digital innovation, we basically pulled together a series of questions which would try and tease out where they were on that spectrum. And as you can see, that the higher priority stuff, to the left-hand side, your right-hand side, is where the industry is still focusing. So still focusing on enablement. There's an awful lot that can be done, and quite rightly, because there is an awful lot that can be done to improve efficiency and deliver a shareholder return in a fairly short period of time. You don't necessarily need to jump straight to innovation at this particular stage. And then finally, so what has that led to? I think if you're delivering so much effort on changing the existing operation, then you need to find new outlets to find new ideas and new operations within the organization. There's only so much capacity for change that you can take on internally. And I think that is basically the catalyst, from my point of view, that is part of the reason why InsurTech or FinTech has really taken off over the last 18 months, is another vehicle to not only necessarily look for opportunities to build technology into the organization, but potentially also to help change the capabilities. And the activity in this space is huge. And growing. So you know, between different insurance accelerators, direct labs within insurance companies. So we're aware of at least 20 venture funds set up by insurers to focus on this particular area and covering 120 investments. You can look at CB Insights and Venture Scanner and get a clearer view. So what does this mean, though? Because if you look at the activity there, most of it is in enabling or at least augmenting the existing business model, not disrupting it. There are 4 roles that we can see that insurer can take. The first one is as a client of this technology, so implementing it. The second one is as a distributor of the technology, being the vehicle to actually enable it to happen. So if you think about the services side of well-being, then that's an opportunity, for example. Insurer is an underwriter, so you think about the data aggregation, the IoT, what the insurer adds to that proposition. And then the final thing it really is as a collaborator, so as an equal partner in that particular space. So if you think about the Zhong'an example. So final thoughts, what does that mean? So the takeaways for this is really, you know, the industry, from our point of view, if you believe those provocations, those 2 points, is the reason why digital is so popular today in one perspective anyway, is because it's under a lot of pressure to reinvent itself financially. The second thing it really is that the industry still has a lot of things it can do around just digitizing the existing business, and that's where most of the effort is from an internal point of view. And the third thing really is making the point that in order to change some of those and offer some alternative solutions, the industry is investing in InsurTech and FinTech. The question is, you know, sort of how long-term will this be? And that I can't answer. If I could answer that, I wouldn't be doing this. I'd be on the other side of that curtain. So hopefully that's been informative and interesting. Most of it I'm sure you probably know, but at least hopefully it positions it in a different context. Thank you very much.